I'm Roger Montgomery and welcome to this week's Video Insight. Today we're diving into the bond market and why it's flashing red for investors, policymakers and the economy alike. Yields are rising, term premia are surging, and underneath it all, a structural shift that could upend how global markets function. Last week, US Treasury yields surged again, back to levels that have historically triggered market turmoil. The 30-year yield punched through 5%, the highest since October 23. The 10-year climbed to 4.59%, matching levels that previously forced even Donald Trump to back off tariff escalation. And what caused it? It was a lackluster auction of 20-year bonds, where demand was soft, which is of course a red flag in itself. And behind this, a bigger storm is brewing. Investors are losing appetite for US Treasuries, or so it seems, just as Washington prepares to unleash another flood of debt. The US government is staring down a fiscal cliff. US President Trump's proposed tax bill, if passed, could balloon the deficit by trillions over the next decade. Moody's is already reacting, downgrading America's credit rating, citing the, quote, increasing burden of financing the deficit. The Republican-controlled House has passed Trump's, quote, one big beautiful bill act, end quote, but the Senate debate may produce changes. If enacted, however, as it currently is drafted, the House bill would make permanent Trump's 2017 tax cuts, while adding new tax breaks for tip income, overtime pay and older Americans, among other provisions. If it passes the Senate as is, expect even more debt issuance, and more debt in a market where demand is faltering means one thing: higher yields. And the other reason yields are rising sharply: term premia. This is the extra return investors demand to hold long-dated bonds. According to some researchers, since 2010, term premia have accounted for 95% of the movement in 10-year Treasury yields, up from just 47% historically. And the trend seems to be getting worse. It's being driven not by inflation alone, but by imbalances in global liquidity, collateral availability, and changes in how governments fund themselves. Think of term premia as the market's barometer of risk, uncertainty, and supply-demand dynamics. And right now, it's rising, and quickly. Perhaps more worryingly, as demand for US bonds softens, the US Treasury may no longer be a price setter in the bond market. It may become a price taker. Global bond markets, especially Germany and Japan, are pushing yields higher, and the US is simply reacting. A major reason is the shift in how the US issues debt. Instead of locking in low rates with long-term bonds, Treasury has been stuffing the market with short-term bills. That might look smart in the short run, but it leaves America dangerously exposed to rising short-term interest rates. Meanwhile, long-term investors, pensions, insurers and so on, they're left chasing scarcer 10-year bonds, driving prices up and artificially suppressing yields. And that's creating a dangerous illusion of stability. There's another consequence. Banks are stepping in to absorb short-term debt, effectively monetising the deficit. And that's a fancy way of saying government spending is increasingly being financed by money creation. And it's not just the US. Britain and Japan are heading down the same road. It's what some are calling Yellonomics, fiscal dominance dressed as monetary policy. And history tells us it never ends well. All this is already filtering through to consumers. Inflation expectations, as measured by the Michigan survey, are surging. Bond markets are sniffing out trouble, even if the Fed isn't ready to admit it. And if term premia keep rising, the Fed won't be able to cut rates, even in the face of economic weakness. Yields of 5 to 6% on the 10-year could become the new normal, unless a recession forces a reset. So where does this leave you? Well, bonds are increasingly volatile. Yields are being pushed by structural forces, not central bank policy, and inflation risks are rising. In that environment, investors are understandably looking for protection. While some investors are turning to gold and Bitcoin, you might think that's a little bit too speculative. And I think for you, it might be worth considering private markets such as private credit. The message from the bond market is clear. The age of easy money could be over, and the cost of government debt could be rising faster than anyone would like. If you're watching the bond market, you're watching what is arguably now the truth. And right now, that truth is getting more expensive. If you found this analysis useful, don't forget to like, subscribe, and share with anyone who still thinks bonds are boring. And don't forget to follow us on Facebook and X. And I look forward to talking with you again next week.